Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a uranium expert for many years at Uranium Insider, which is a paid research newsletter covering the entire uranium and nuclear power industry. These uranium stocks that have been on absolute fire for the last, I would say, 9 to 12 months. Literally, it's the old school Sir John Templeton bull market. It's been built on pessimism, skepticism. We've just had an absolute soaring in the spot price in uranium. We were talking before we started recording with expert Justin Huhn. What is the uranium spot price at right now, Justin?
Right now, currently today, the print was $106. It's been there for the last 4 or 5 trading days.
And how much is it up in the last 12 to 18 months, the spot price?
12 to 18 months. Let's see. It ended 2022 in the low 40s, if I recall off the top of my head. So it's more than doubled in the last 4 to 5 months.
That's insane.
Yeah, it was besides, I think, sugar or there was some other kind of commodity on the fringe that was up a little bit more than uranium, but besides that, it was the best performing commodity in 2023.
Well, props to you, man. I was interviewing you a lot in the last 12 to 18 months, and you were telling people that something like this could happen, that the probability was pretty good. Obviously nothing is guaranteed in these markets, but the risk reward, the supply demand fundamentals were saying that the uranium spot price was going to go up. It wasn't going to stay around $38 for very long.
Yeah, thanks. I appreciate that, Jason. It's not a really difficult call necessarily to just say, oh, the price will continue to rise because the supply and demand fundamentals are pretty clear for anyone to see and to dig into. And then nobody really knows the exact trajectory, how quickly or how sharply it'll rise. And I think the rise from August to December of last year caught pretty much everyone off guard. There were very few participants in this industry that expected the price to rise in that manner. A couple of the guys that were kind of in the markets on a day-to-day basis, like literally transacting in the physical market, could see things tightening up. And as the price has risen over the past number of years, it's progressively gotten less and less liquid, especially in the spot market. Now at $106 a pound, we have a situation where everybody who has any inventory on any level is just holding on to those pounds tightly because they become more and more valuable as we progress into this supply deficit. And why sell today if you can hold on for a week or maybe two and sell for another $5 or $10 a pound? That's kind of the sentiment that's in the physical market right now, and it's extraordinarily tight. There's a number of elements that are historically unique, and I can get into that as much as you'd like.
Excellent. And we're recording this interview on Monday, January 22nd, 2024. And the uranium spot price it's around 106, which is just incredible considering I remember not early 2023, it was $38, $40 is in a range. And then I remember it got to 50 and then 55 and people like, no, it's going to crash. And the skepticism and the skepticism in it was just really, really bad. But I guess that's what bull markets are built on long term. And then we have the policy changes, and I'll ask you about that later in the interview. First, though, for our listeners out there about the spot market, Justin, who is going to go into the uranium spot market at current prices and buy? Is it electrical utilities? Is it hedge funds? Is it Cameco? Who would be buying at the current prices?
It's a little bit of everybody right now, Jason, and where you would see over the past few years, up until maybe the last 6 to 8 months, you primarily had traders and financial interests. The utilities were largely not engaging in the spot market very much. It was tight enough for the past few years where the utilities understood that if they came into the spot market in size, it would move the price a little bit, and that movement of price would affect their market reference portion of contract deliveries, even from contracts they signed many years ago that are being delivered on right now. So the utilities, generally speaking, don't really go into the spot market all that much. Unless they absolutely need to. And some exceptions to that would be unexpected life extensions. So, for example, the early part of last year, we had PG&E, who's the operator of the Diablo Canyon plant in California, when they had a 5-year life extension basically confirmed by the state of California. They came in the market with a pretty chunky RFP. So this was February, March, April of last year, and it took multiple months for that RFP to be filled. And it was pretty sizable. If I recall off the top of my head, 5 or 6 million pounds of U3 equivalent. And they would take it in any form. They'd take U3O8, they'd take UF6, they'd take enriched uranium if it's at the right enrichment level. And that moved the market a little bit. It moved the market a few dollars, and it also just kind of signified the tightness in the market. That was one big signal. You also had the Koreans kind of do a 180 on nuclear. They had idled construction of a nuclear power plant under the previous administration that was anti-nuclear. The current administration is pro-nuclear, so they shifted, started construction back up on this plant, and they've came in with an RFP a few months after PG&E did. And the Koreans kind of enter the market in sort of a unique manner traditionally, and they did so with this RFP as well, where they actually dictate the pricing and the size of the RFP. So they say, we want this many pounds, we want it at this these delivery timeframes, and we are willing to pay this price. Whereas most others just enter what form they want, how many pounds they want of U3O8 equivalent, and the timeframes, and then they get offers from various market participants. So the Korean RFP actually went unfilled. Nobody responded and was willing to fill that RFP at the price that they desired. So those two elements last year were pretty significant in the spot market. And I think that those led up to the price rise that we saw that started back in August. So right now, to answer your question in a more succinct manner, traders, utilities in small volumes, there are hedge funds and financials, but the volumes are very, very small. And then interestingly enough, and I think most profoundly, producers are buying in the spot market. And I'm not just talking about like pre-production companies like UEC and Denison that have purchased pounds in the past and are once in a while in the market buying and selling, but actually the big producers of the world are buying in the spot market. The Russians have been buying in the spot market. The Chinese have been buying in the spot market. Kazataprom is buying in the spot market, and even Cameco is buying in the spot market. So that, I think, is a fundamental crucial piece of information for anybody invested in the space to understand that the primary producers of the world, these are Chinese utilities, Russian utilities, and then Cameco and Kazataprom and their joint venture partners are all buyers when they're the ones that are supposed to be producing and selling into the market. It's a fundamentally new realm that we're entering here.
You also have over a full 12 months of Sprott Physical Uranium Trust, and they were buying when the prices were low too. So that's creating a higher price floor, I would say. But for listeners out there, I mean, Cameco, did they still have Cigar Lake and MacArthur River shut down? I mean, they were buying in the spot market for a long time, right?
Well, when they shut down MacArthur River, or put it in care and maintenance, I should say, in 2018, that yes, there were buyers in the spot market. They were very vocal about that buying, and they wanted to help that shift because the miners, with some exception, primarily Kazatomprom and some of their JVs, were the only ones making money for a very long period of time during the bear market, and all of the other miners went through an excruciating period of time. But the price was so low, we had abundant above ground mobile inventories. We had utilities engaging in carry trades, with traders actually just buying off of the spot market to fulfill those contracts, and the miners were sort of left for dead. So when Cameco decided to take one for the team, put MacArthur River on care and maintenance, that was a very painful experience for the company. It cost them a lot of money to just keep that highly complex mine in care and maintenance for a number of years, and then buying in the spot market. So not only were they not producing, they were buying. It had kind of a doubling effect as far as supply and demand goes. Now they're buying just kind of on the margins because their production isn't sufficient to fulfill into their contracts. And this isn't huge volumes, but it's not taking a lot of volume to actually move things in the spot market. We're seeing 100,000 pounds here and there move the spot market multiple dollars. And the other thing that's really affecting Cameco and the other producers are just the flexing up of these contracts. These are contracts that were signed 2017, 18, 19, 20, where it was still, we were in a price recovery situation in the spot market and the market in general for the physical uranium, but it was still very much a buyer's market. There was still sufficient above ground inventory. The market had plenty of liquidity in terms of physical, and the sellers would give sort of these juiced up contracts, kind of a bonus to the buyers to incentivize them to engage in business with them, which would be these flex provisions. And this is not something new. This has been happening for decades, where at the time of delivery, the utility would have the option to flex these contracts up or down, sometimes as much as 20%. So at the time of delivery, you could decide if you wanted to receive more or less material. In a bear market, utilities would flex down. Why? Because they could receive less material under the contract, which was at least partially fixed price. And if it was a bear market at the time they signed the contract, the price was probably a lot higher than the current time where they would accept that delivery. So they flex that contract delivery down, they go in and they top up in the spot market. The opposite is true in a bull market. At the time of delivery, typically the price in the market is higher than at the time you sign that contract, which at least is partially fixed price. So you're going to flex up and receive as much as possible that is partially fixed because it's substantially cheaper than that market reference price. And that's
So
exactly what has been happening. Yep.
so
Go
you're,
ahead.
for our listeners out there, you're using industry specific terms, but this is a long-term contract price versus a spot market price. So if a utility locked in, let's say, a certain percentage of the supply they need at a long-term contract price, I was going to ask you about the discrepancies of the long-term contract price versus the spot price, which is around 106.
Sure. Yeah. So they're separate markets, but they're essentially linked. I mean, the spot market and the term market are basically the same market. It's just that the spot market is any trades buying and selling that happens with less than a 12-month settlement on that purchase. The term market is everything beyond 12 months. So traditionally, utilities will get 85+% of their needs met in the term market. They think long term, they buy in contracts that usually last. And this, of course, also, Jason, is dictated by whether it's a bull market or a bear market. So in a bear market for the commodity, there's usually a lot of inventory, which is why the price is dropping. And utilities will engage in shorter term contracts. So they'll go out and sign a 2, 3, 4, 5 year contract, maybe. When things turn around and supply looks a bit more scarce and they believe that the price will be higher in the future, they start to sign much longer term contracts. So we're talking 7, sometimes up to 10-year long contracts for delivery way out into the future. That's exactly what we're seeing now. And so oftentimes the terms of the contract shift depending on the bear market, bull market, right? So the 2010s, the terms typically were some percentage fixed price. So at the time you sign the contract, so just to give you and your listeners an example, a contract that let's say Cameco would have signed in 2018 or 19 would be $40 or $45 fixed price. And maybe that's 60% of the contract, and 40% would be referenced to the market price at the time of delivery. So if they sign a contract in 2018 and 2023, those pounds are delivered onto the utility, and we've got a price of $50 a pound with the fixed price at 40, the utility is going to flex up all day long and get as much as they can out of that delivery because they can't just go in and top up in the spot market at a lower price. And that's obviously super clear right now. So what that means is for all of these producers that are fulfilling contracts that have been signed over the last 5 years, all of them have been flexed up on by their utility customers, and that has caused an extreme tightness in the near and midterm market for producers. So inventories for producers have been drawn down. If the producers are having any sort of production delays or misses on their production targets, that creates even more buying pressure in the near term in the spot market. All sorts of elements have sort of conspired for an extremely tight near and midterm market for producers, and utilities are slowly kind of waking up to that realization. And it's being expressed in the terms of the new contracts that are being signed right now. These contracts are going out into the 2030s. We've heard about contracts for enrichment being signed into the 2040s. So these contracts are being signed 7 to 10 years long. And the big difference also, no flex provisions are being offered by producers right now, and the contracts are 100% reference to the market. I'm even hearing, Jason, now that some of these contracts we're starting to see no ceilings in the contracts. That's how desperate the buyers are starting to be. So typically a market reference contract would have floors and ceilings. The floor would protect the producer, right? So if we have some unforeseen event where the price actually falls below, the prices at the time of the contract is being signed, that floor will protect the producer, and the ceiling will protect the buyer. Okay, we're going to sign this with a floor at 75 and a ceiling at 110. So if the price overshoots to $175, you'll never pay more than 110. Now we're hearing that the ceilings are potentially starting to being pulled out of these contracts. It's fully a seller's market.
So it sounds like inventory has been cleaned out. We'll talk about spare capacity in a minute or two if Cameco and Kazataprom can bring on spare capacity, because there's been some articles and some updates in the last 10 days about that. But then also, I mean, the uranium industry is still dealing with all the same problems, and we've discussed this, Justin, in the past interviews, that all the miners, so gold miners, copper miners, all the input costs. So even though there's quote unquote deflation, I mean, in a lot of emerging markets, you have diesel costs, electricity costs, labor costs, cost of capital with the interest rates. These input costs are up. So is there a lot of incentive for Cameco and Kazataprom to bring on a lot of new supply in the near term?
I would say yes. I think that we're starting to see the gears slowly start to turn in the industry for production to come online. The problem is that it takes so long and it costs so much to do so that it never happens on time, on budget, even for the established existing producers. Case in point, Jason, just a couple of weeks back, Kazataprom announced to the market that they are likely to not hit their production targets for 2024 and probably not for 2025 either. Later, let's see, this was September, I think, of 2023. Kazataprom announced that they plan to increase production in 2024 to 10% below their subsoil use agreements, which is about 25,500 tons, or about 60, let's say 66, 67 million pounds of uranium per year on a 100% basis for 2024, and 100% of the subsoil use agreement contracts for 2025, which would be 30.5 to 31,500 tons of uranium, almost 80 million pounds. That's a massive production increase. But they signaled to the market just a couple weeks back that that is unlikely to happen. They highlighted sulfuric acid shortages and slight delays in the development of some of these new projects. These are primarily joint ventures with Orano from France and with Rosatom, these two big new deposits. And one of the biggest new deposit would be the Budnovskoye 6 and 7, which is a Rosatom joint venture. Both of these projects are delayed. They're needing more and more sulfuric acid to squeeze more and more uranium out of these declining deposits. And we've been looking at their capex every quarter. They produce their financials to see if we see a big bump in capex, because you have a 8 to 12 month delay from the capex to see that increased production. It's just not there. So it was a pretty easy call that we made just 4 or 5 months ago. They're going to miss. They're going to miss. They're going to have to tell the market they're going to miss. And when they do, it's going to be a catalyst. It's exactly what happened a couple weeks back. Now we have Cameco's conference call coming up in about 2 weeks. We think that they're going to say that they missed their production targets for 2023. We don't know what they're going to say for 2024. They usually put on a brave face, but we know that even the biggest producers like Cameco and Kazataprom, they're having supply chain problems. They're having higher input costs, elements that they need to purchase with these supply chains just for their ongoing production. Instead of taking a week to deliver, it takes a month and it costs twice what it did 2 years ago. This is affecting every element of the production cycle. And that's not even to get into the shortage of skilled labor. These primary producers are having a hard time attracting the skilled labor. So it means it's a big signal for the actual developing companies and what the industry can expect for new production going forward. It's a big question mark.
Has Cameco restarted Cigar Lake and MacArthur River, both of them yet?
They are both producing currently. They were shooting for, they had to revise down their production target for Cigar to 16 million pounds for 2023. MacArthur, they're shooting to get to, I think, 15 million pounds for 2024. Both of those targets, I think, are going to be a struggle for the company for the various reasons I just mentioned, but they are both producing currently.
I think that's way below what the mines were initially planned at. So I think they have restarted them, but they're nowhere near what the original production capacity was planned at.
Typically, you would expect 18 million pounds a year from both mines. Cigar Lake, phase 1 of Cigar Lake, of that deposit, is supposed to be kind of tapped out by the end of the decade. I think we're already starting to see declining production rates coming from that mine. Now, the company will tell you they're going to step into phase 2 of the mine when they get to a certain level of depletion out of phase 1. We know that that's lower grades, higher cost of production. I think that they'll end up doing it, but it's just they can't just snap their fingers and go to full production. It's very, very difficult mines, and I guess the same thing goes for Kazataprom. They need a lot of sulfuric acid. They need a lot of capex spend. They're printing money hand over fist right now at these prices, but even with the enormous profits the company is printing, they can't just turn on the taps. That's primarily the biggest concern that investors have had in this space over the past few years is, oh, we're going to get to X pound of uranium and Kazataprom is just going to turn on the taps. It'll be over. Well, that was a big signal a couple of weeks back. That's not the case.
Yeah, my friend and natural resource commodities expert Rick Rolla said the cure for high prices is high prices. Well, the problem, I think you just outlined it in a lot of detail. These are not, it's not like an oil well, shale well that can be drilled in 4 to 6 weeks. And there's a lot of oil production. And even though it depletes rapidly, I mean, turning a mine back on, there's all these problems, there's all these costs, especially if Cameco is going to invest in a phase 2 of a project. I mean, the prices have to stay at a certain level. The projects almost never come on time and on budget. So are we looking then add at least a couple years in before more a substantial amount more supply comes online from mines?
Yeah, I mean, I think Rick Roll is essentially right. I mean, that's kind of a quick answer for commodities markets. High prices do eventually cure high prices, and we will have supply response at some point to this pricing environment. So it's the problem now is not the incentive price, it's time, and that we need more time in order to see supply come on and fix this deficit. All the while, seemingly nuclear is becoming more and more de-risked, kind of on a global basis, with life extensions, with new builds being announced. So the underlying demand picture is relatively stable and growing. But what we're seeing right now currently is the developers, like I said, the gears are starting to turn. So Global Atomic is working towards developing the Dawson mine in Niger. Of course, that's been interrupted with the coup of last summer. That probably delayed the project by at least a year, but they are still moving towards that. So that'll be four plus million pounds a year in about 3 years. NextGen is developing the Arrow deposit. This is the really big one. This is a very large underground mine. It's very deep. It'll be the largest uranium mine in terms of pounds of production per year that has ever been built, pushing into the high 20 million pounds per year according to their feasibility study. That also is not a snap of the fingers. The company will tell you first production 2027. I think pretty much everybody will take the over on that. I think 2028 is optimistic and probably late decade. If you asked industry executives with decades of experience in the nuclear industry and the uranium mining industry, they'll tell you 2030 is most likely for NextGen's Arrow. Denison has a project, the Phoenix project. It's an ISR mine they are building also in the Athabasca Basin, Saskatchewan. Same thing, 2028 production. We have smaller ISR projects that are starting to come online and are just getting into production. So that's Boss's Honeymoon in South Australia. That's Encore has a couple of projects in ISR projects in the United States, and those combined with Energy Fuels getting back, all told, these smaller projects will have maybe 2 to 3 million pounds of more production this year, maybe 5 million next year combined. They just don't solve the supply deficit. The big one, of course, is Kazataprom. They have, like I mentioned, the Budenovskoye 6 and 7, which is the Rosatom joint venture, and then the South Tortkoduk, which is a joint venture with Orano. Those are the two big projects. They're experiencing delays. But the big one, which is Budenovskoye, 5 years, the first 5 years of production from this mine on a 100% basis. So not only Russia's share of that mine, but also Kazatoprom's share of that deposit. All of those pounds are going to Russia for the first 5 years. So more and more production coming out of Kazakhstan is being committed to Russia and China. Uzbekistan is ramping about 10 million pounds a year right now that they currently produce. They'll be at 15, 16 million pounds by the end of the decade if they're lucky. So yeah, production is responding. Supply is responding. The problem is that we have a lot of uncovered utilities and a lot of uncovered buying that needs to happen by utilities going out to the late part of the decade with an extremely tight and arguably overcommitted midterm by the existing producers. So pretty much everybody in the market is short right now. China is the only buffer with their inventory. The only problem with China is that they don't care about scalping profits by selling out these strategic pounds. We have not seen liquidity come into the market from China. The exact opposite has been the case. As we've seen prices rise over the past 2 years, China has been the most aggressive buyer by a very large margin. So far, that has not added any liquidity in the market. Will they someday? I don't really know. We're watching it closely, but it doesn't look likely.
And also for many years during the bear market, while Kazataprom was actually increasing production too. So our listeners can go on a chart of the Kazataprom website and see that they were increasing production during the bear market. You also had Japanese utilities that were dumping uranium back onto the market. So I would say that that's probably not the case anymore either, because it looks like Japan's probably going to start restarting more nuclear power plants too, that they're not going to be net sellers of enormous amounts of nuclear fuel rods anymore going forward.
Yeah, Japan had a pretty chunky amount of inventory following the closure of all of their nuclear plants following the Fukushima Daiichi accident, and that of course led to a certain amount of inventory coming to the market, probably pushing 100 million pounds following Fukushima all told, and possibly a bit more. Now maybe it's a few million pounds a year, but like you mentioned, we've seen increasing restarts. It's not a super accelerated pace of those restarts as the market assumed a couple of years back when we saw some pretty strong language coming out of Japan in terms of their restart pace. It's still, one a year-ish. If they want to hit their targets, it's going to have to be more than that. But either way, it doesn't really matter what that accelerated pace is in Japan. What is the evidence? The evidence is that we have multiple Japanese nuclear utilities in the term market. They've entered into the term market over the past, 18, 24 months. So on balance, the Japanese are buyers, not sellers here.
But I think the big news, and I'm sure listeners who have been following uranium and nuclear power for a while, the big news that's come out in the last 6 weeks, I don't know if it's affected the price yet because the price was already an uptrend. But I think now these governments in the European Union, the United Kingdom, they're starting to realize that we were talking before I started recording that just domestically, if you're running a small business in the United Kingdom or European Union, all of a sudden you're a small business owner, you get an extra $1,000 electrical utility bill per month. You're debating whether or not you can run your business. So the stability of these domestic economies that are manufacturing, if you do not have long-term, stable, reliable electricity prices that are relatively cheap, and you're reliant on liquefied natural gas imports or coal, and the prices start to spike. So that's why we're seeing, I think, with the news coming out, Justin, in the last 6 weeks, whether it's the COP28 conference, the announcements, or the United Kingdom, we're just seeing a lot of potentially bullish news long-term for nuclear power. Now, it's just talk, though, right? Because has any of these governments actually made any investments yet? They're talking about that they're going to be investing in nuclear power for the next couple decades, but it's just talk right now, or are they actually putting shovel-ready projects into spending on those?
As far as the countries that actually signed this pledge at the COP28 conference, there were 24 countries that pledged to share in a goal of reaching a tripling of nuclear power by 2050 as part of their quote unquote net carbon net neutrality goals. Following that meeting, so that was just back in November, so it's only been a couple of months, but the two main stories that we've heard following that have been in the UK. UK is investing, I think it was 500 million to establish a high assay low enriched uranium HALEU development in the country, which says a lot about their goals for nuclear. They are going to proceed with building the new large nuclear power plant that's in the early stages of construction, but if they're investing in HALEU, they're looking at SMRs and advanced reactors. So that's a good sign. That's a pretty sizable investment. The other one is France. So France famously kind of did a 180 about 3 or 4 years ago with Macron, where he basically said, "Oh yeah, we're not phasing out nuclear, we're keeping nuclear, and we're actually going to be building new plants and likely life extending some of the newer plants that they have currently operating." So some of these new plants, or the new design that EDF in France would be building, are these EPR2s. These are massive reactors. They're 1,460 megawatts per reactor. They want to build 6 new reactors. That was announced about 2 years ago. And then just recently, since the COP28 conference, they're saying they want to build an additional 8. And their time frame is, it's a long term. This is not happening tomorrow, but 14 new EPR2s. In addition to that, EDF, which operates 8 of these older reactors in the UK, is going to be seeking life extensions for these 8 reactors. And so these eight reactors on balance, if they even give a 2 or 3 life extension to these, that means EDF's going to be in the market looking for some near-term supply to life extend these reactors. So those are kind of some two a bit more concrete steps. This isn't actually shovels hitting the ground yet, but this industry moves very slowly. And the great thing about the investment thesis here is that while bullish fundamentals for nuclear going out into the next decade and countries committing to building new plants, it really doesn't matter for the next few years of the investment, and just based on the structural nature of the physical market, we could have 0 new projects hit the ground and new construction starts over the next 5 years, like 0, and this investment is going to play out. And that simply has to do with the existing fleet that's operating. We know which plants are going to be operating. There's a number that might be shut down or life extended. That remains to be seen. But the existing operational plants and the uncovered needs of the utilities operating those plants, that's the demand that we can model out and see what that looks like in the physical market. And then the supply is even easier to model, because you can look at the mines that are currently operating, you can look at their projected production levels for the next 3 to 5 years, and then what is going to come online. Even if you're conservative and say, okay, these projects are going to come online on time, on budget, just as the company says in their investor presentation, we're still short. So what is a pound of uranium worth in an environment where there isn't enough to go around? We're about to find out.
And it looks like Sweden and Hungary are also announcing additional plans for nuclear power expansion as well. So again, this is potentially bullish news, but talk is cheap. So we'll see if they actually do make the capital allocations, because I think the European Union governments are realizing that they can't get good return on investment, positive return on investment on wind, solar, biofuels. I mean, look what happened to Germany with all the losses on wind and solar. I think the Siemens division of their wind and solar, they had to do bailouts. So that's how much money they were losing. German businesses, German manufacturing, a lot of other European businesses, they just got hit with record amounts of higher spikes in electricity costs. And really the only one long term, and I also like liquefied natural gas and natural gas long term, but in terms of actual like steadiness for prices and locking in a cheap price, I think nuclear power is just better on the economics than liquefied natural gas.
Yeah, you're exactly right, Jason. I mean, Germany has been such a wonderful use case for what not to do. And that, if anything, that's kind of a silver lining of looking at how things have played out for the country over the last, 8 to 10 years, and especially more recently, is this is exactly what happens when you shut down clean baseload power. You inevitably have to rely on other sources of baseload because your investment of $500 billion into solar and wind just isn't cutting it. And we've seen enormous increases in the cost of electricity in Germany. We've seen obviously a much dirtier grid. We've seen major companies leaving. BASF, one of the largest chemical companies in the world, left the country. Volkswagen was talking about leaving. I mean, it's been an absolute hammer to industry in Germany. Now, what's really interesting is a number of these plants are restartable. In fact, our friends at the Radiant Energy Group went over and did a study, and they determined that 8 of the nuclear reactors that have been shut down in Germany technically could be restarted. We're actually seeing a couple of prominent political parties in the country say that they want to restart a number of these reactors. And so we actually believe that they will be restarted. Some of these reactors will be restarted in the coming years because it just has to get bad enough to where the populace turns and says, hey, you guys screwed up. We screwed up by supporting you in these decisions, and it's time to flip that. And in the end, physics is likely to win out, to paraphrase Doomberg. We believe that's the case. And Germany's been a great use case for all the world to see.
Well, Germany's just throwing tons of money at everything. I think they've rented or leased 3 floating liquefied natural gas import facilities. They used a ton of coal and wood. Global coal demand, I think, actually shockingly hit a record in 2023, but a lot of that was from China. But nuclear power just makes so much sense long term, especially with liquefied natural gas. I mean, the cost, if someone were to look at the economics of building a liquefied natural gas import facility, I think it's at least 2 or 3 times more cost. And then it's not even counting the variable cost for the imports of liquefied natural gas imports versus a nuclear power plant.
Yeah, and there's, one of the most important points I think to compare these different sources of electricity is that nuclear has an enormous advantage over most different various sources of electricity, and that's that you can store decades worth of energy in terms of nuclear fuel rods, fabricated fuel rods, in a relatively small warehouse. So even if you were to compare cost of establishing a nuclear power plant versus establishing an LNG import terminal, you would have 60, 80, potentially 100-year long-lived valuable asset, and you can store decades worth of electricity fuel in a warehouse. It's a huge asset for any country, that, especially a country like Japan, that doesn't have a lot of domestic sources of energy. They don't have a lot of domestic sources of coal or natural gas. They're importing basically all of their energy, or their sources of their energy. But with nuclear, they can actually store a lot of that energy in a relatively small space, and it's a very, very important element in terms of electricity and energy security for countries that choose to go that route. The Chinese know it. They're building like crazy. They've got 25 reactors currently under construction. 25. Or in the United States, it's all talk. Maybe we'll do this. Maybe we'll do that. They're just doing it. And they're thinking in terms of decades as well. So that's a huge advantage of nuclear. Even if you compare the costs. The average cost, if we, you can look at the United States and look at Vogtle and see the major cost overruns and time overruns for that plant. But even with that, Georgia, the state of Georgia in the United States, is talking about potentially wanting to build more nuclear. That's really interesting. But if you look on a global basis, the average cost to build an 1,100 megawatt nuclear power plant is between 6 and 9 billion. And then you have to factor in the fuel for the reactor typically is only about 15% of the operating budget. And that's the entire fuel cycle. That's the mined uranium, that's the conversion, that's the enrichment, that's the deconversion, that's the fuel fabrication. About 15% of the overall operating budget compared to a natural gas plant where the cost of the gas is a very large percentage of the operating budget. So it has that advantage as well.
Well, the liquefied natural gas import facilities, they're being built. The press releases are, or the ones that started construction, the costs on them are super expensive. You have the variable input costs, like you said, but you're also using a tremendous amount of energy. You either have to build a pipeline network to move the gas to a major city or metro area, or you have to figure out how to ship it by rail or those tanker trucks that are insulated. So there's all these extra costs and problems. You're looking at tens of billions of dollars to build out these liquefied natural gas import facilities. Germany just has, I think, 3 floating ones, but those are only temporary, and they spent what, 500 billion or something on those. It was very, very expensive.
Unbelievable. Yeah, it's so easy because you have to have a nonstop importing, especially in the case of Germany or the UK, for example, where they're not actually drilling out their own natural gas. That can be cut off relatively easily, and we've seen exactly that in the current conflict with Russia. The energy can be weaponized in a moment's notice, and without having enormous amounts of inventory held, which is much more difficult to do with natural gas than it is for nuclear fuel. That can be weaponized in any sort of geopolitical strife. So there's a huge advantage in terms of energy security with nuclear.
Yeah, I agree. And there's really only 5 countries that are doing liquefied natural gas exporting at scale. I mean, you have Russia, Qatar, Norway, the U.S. The U.S. is the major one where there's enormous growth. I think the U.S. is now the world leader in liquefied natural gas exports. I think it's even
Right.
supposed to double by 2030. So, and then you have a smaller amount in Australia. So it's very, very expensive to do liquefied natural gas, and you're using the energy return on energy invested at the import and export facilities. Super expensive in general across the board for all the costs.
Right. Yeah. And even if we have, somewhat of a hydrocarbon revolution, especially happening right now in the United States, you're still seeing, I mean, to bring it back to nuclear, you're still seeing many countries around the world focus on nuclear, not only for a clean energy or low or zero carbon energy source, but because of the fuel security, energy security elements I mentioned. It's not a one or the other necessarily.
So Cameco stock is up a lot. I wouldn't call it a value stock anymore. I mean, risk reward a couple years ago when it was between 8 and 15 or $20 a share, it was cheap. People hated it. I thought it was a good bargain back then. Are there any near-term uranium producers? Let's say they're building a mine in a relatively geopolitically safer area. It's going to be a sizable mine, and they already have the funding. You think our risk reward could be the next Cameco?
Oh gosh, the next Cameco. That's a tough call. I mean, the largest development project in the world is NextGen's Arrow. So if we're talking about on a total pounds produced per year basis, that's pretty much the only one. There's the other development projects I already mentioned. Global Atomics DASA. That's a much smaller project, but still the highest grade project in Africa. We haven't heard of any of the development projects in Namibia actually getting into construction yet. A couple of the companies are looking to do final investment decisions this year, potentially start developing these projects next year or the year after. It's going to be a few years beyond that before first uranium's out of the ground. And that's, of course, also not considering that there's major water issues and water shortages in Namibia that are impacting existing producers in Namibia currently. So not really sure how that gets resolved unless we have, new desal plants built, which is possible, but that takes time and money. Like I said, in the US, we've got a number of smaller ISR producers, but who's the next Cameco? I mean, I think the only option really is NextGen in terms of the size of that project. It's just a monstrous project. I would not be surprised to see some multinational mining company potentially come in and take them out. And especially, I mean, just look at the project cost and the valuation of the company based on these uranium prices. And this is something I keep thinking about, Jason, is you have a lot of these developing companies that have done feasibility studies in the last 3 to 4 years where they're basing these feasibility studies on 55, 65, maybe $75 a pound uranium. Here we are at $106 and headed higher. These feasibility studies are going to be updated. So we're looking at, like a NAV for NextGen at like 7 billion. That moves to over 10 billion at $105 compared to 75. Just a massive, almost a 50% increase in the NAV of the company, just based on that $30 a pound uranium price. So we're going to see drastic valuation reevaluation of these equities and some of these projects based on this much higher uranium price. And that's really what I think we're entering into now, is kind of a new paradigm for the industry. I don't think we're going to see a price spike and to have the price settle back down below $100. I just don't think it's there. We don't have the supply to support that environment. So I don't know where the price is going to go. I think it could go potentially higher than most of the bullish price targets they're all arbitrary anyways. Like I said, we're basically at or near kind of an incentive cost for the marginal projects of the world. It just takes time to develop these projects, and it's going to be many years before we have a ramped Kazakhstan, a ramped Uzbekistan, and arrow producing. I mean, we're talking 4 to 5 years minimum. So what happens between now and then is anybody's guess. But I do think that we're going to have to see updated feasibility studies when we have this new reality set in, that uranium is no longer $25, $35, $45, and it's not going back there anytime soon. And the sooner the utilities actually wake up and realize that and come up to the table and secure contracts going out into the 2030s at prices where we're at now and higher, then we can see the analysts come in with reports looking at the net asset value of the projects of some of these companies with an imputed price far higher than their previous feasibility studies. And that's when I think we get a major re-rating in the equity prices. And I think that's happening. And I think the investing world is going to see that first, right? Because it's always forward looking. The investors have been right about this sector since the bottom of the commodity. So, the Mike Alkins of the world that operates Sachem Cove, which is a specialty fund that's focused on uranium, he was one of the first to really come out publicly and talk about the sector and say, we've got a major structural supply deficit. Utilities are going to have to step up. If they don't, this is what is going to happen. That's exactly what happened. Way higher prices. Liquidity has absolutely dried up. Inventories are being held more tightly, not less, in a higher price environment. That is opposite of what kind of makes sense, is, buy low, sell high. But that's exactly what has happened. And I think that the investors are going to actually see this almost as a second wave of contrarianism, where you look at the price chart and you look at it, it looks like a hockey stick, and you say, well, this can't last. Well, what if it does last? At what point do the investors and then the industry say, okay, this is here to stay? What are these things worth at 150 plus uranium? Because I think that's where we're going.
Buy low, sell high doesn't make sense if you're an electrical utility company operating nuclear power plants and you don't want to dump the uranium back onto the market at a profit, because you actually need the uranium to run your nuclear power plant. So I would argue that buy low, sell high in that sense doesn't work, because you don't want to be dumping supply back on, because you actually need it for something useful.
Yeah, 100%. And I'm not going to be the one that's going to say that the cost of uranium is absolutely negligible. It's not. It actually matters to the bottom line, especially if you're operating in a deregulated market in the United States. You actually have to compete with natural gas and solar and can't necessarily pass those costs on to your customers. It does matter to the bottom line. I'm not going to say it doesn't. But if you need it, you have to buy it. It doesn't matter what it costs. There's one thing that cannot happen for a nuclear fuel buyer. You cannot not have fuel for that facility. That isn't an option. So if it's $200, you pay it. If it's $500, you pay it. It's one of those things that makes it a very unique commodity in that matter.
Well, that sounds hypothetical. I think what we'll see happen is we'll start to see stuff like Cameco, where some of the electrical utility companies will say, okay, these new projects, like some of the ones you outlined, we're going to make investments directly into the miner. We're going to help bring online with financing costs, because the cost of capital, if these miners need to use debt, the interest rates are high. So I think you'll see some of these nuclear power utility companies directly invest into potentially new projects. And in exchange for funding some of these projects, they'll lock in maybe, I don't know, $80, $100 a pound. I think that's kind of win-win scenario for both the new uranium miners and the electrical utility companies.
Yeah, and we're already starting to see that a little bit in some sense, in that utilities can secure a contract with a developing company and actually make some kind of forward payment. So the developing company will forward sell some pounds of future production, and that way the utility actually is sort of helping to finance the project. We're seeing that a little bit. A lot of the developers now are holding back on contracting too much of their forward production so they can remain relatively unhedged, because everybody knows, even their clientele, which is the utilities, that knows that the price is likely to go much higher. So while it is hypothetical to say, because we've never seen that pricing environment before, to say if it's $200 a pound, they'll pay it. This is something that I hear coming from nuclear fuel buyers themselves. If the price is $1,000 a pound and I need it, I pay it. They don't have the option to not fuel a nuclear power plant. To quote to quote our friend Cuppy, if you don't have the fuel for it, you've got a multi-billion-dollar paperweight. They can't have that option. While I don't think that the industry necessarily wants to take advantage of that, where the price goes is really up to the buyer. And right now, the uranium is trading hands at $106 a pound. And we've been in a stalemate for the past week. It's like both sides are like, okay, that escalated quickly. Now what? But there's just no offers in the market. It's very, very illiquid. There's not a lot happening there. And nobody really knows exactly how high this is going to go. But we do know one thing: utility, if you need uranium, you will pay whatever the market price is to get it.
Well, maybe in the short term, but long term, I'd rather lock in a more stable price, say with investing in one of Denison's new mines in Canada, or is Paladin Energy, are they building a mine in Africa?
Paladin is in the process of restarting the Linker Heinrich mine. They have a good part of their forward production already committed into contracts. And while you're correct in thinking that, Jason, you have to have the producer or the to-be producer willing to engage in those contracts, and not all of them are. NextGen hasn't signed a single contract. And yes, we're 5 years away from their production hitting the market, but they don't need to de-risk financially. They're going to have money thrown at them left, right, and center. So they don't need to actually acquiesce to the market and take money from nuclear utilities. They're going to be able to build it. They're going to be able to finance it easily. So it's not something, usually a producer will sign contracts to de-risk for financing. That's the primary reason they do it. If we're in a rising price environment, it's very, very, very difficult to build a mine. And these producers are not in the business of breaking even, especially if they had to sit through a excruciating bear market where, to be frank, the nuclear utilities didn't really throw the industry a bone. I have a contact at one of the mines. He's going to remain anonymous, but I told him the other day that we had a nuclear fuel conference in Washington, D.C. last week, an NEI conference, is a one-day conference. And kind of the mood in the room essentially was, it's been a rough month for the industry. Like January, we've already seen the price go up, $15 a pound over the past 3.5 weeks. And this person's response, who works at one of these mines, he was like, rough month. We had a rough decade, and they left us for dead. Like, that's the sentiment here. So the miners, unless they need to de-risk from a financing perspective, are not going to be throwing the industry a bone whatsoever.
Yeah, I agree. Uranium miners had the worst sentiment for at least a decade. I mean, post-Fukushima, it was just absolutely terrible for over a decade.
Very, very difficult environment for miners and for everybody across the fuel cycle, converters, enrichers. It was rough for everyone. And it's not, this is just one of those boom and bust kind of commodity cycles, and was largely driven by Japan's choice to shut off all of their reactors, and then Germany kind of followed suit. So it wasn't necessarily the nuclear utilities' fault. But once we started to get to that $18, $20 a pound environment, Cameco's up here saying, hey guys, we need 40. How about signing a contract going out into the mid 2020s and at $40 a pound, and throwing us a bone here to keep the lights on? And nobody did it. Nobody did it. Because if you're a nuclear fuel buyer, you can't go to your manager and say, hey, Jim, Cameco wants $40 a pound, but I can buy it from the Uzbeks for 22. What do you think? Like they just didn't have that option. And so I don't want to say it's an adversarial relationship, but mining is an unbelievably difficult business. And these companies are in business to make profits, and they're going to profit enormously from what's about to happen.
Well, also the US and Western governments for the last 15 years, 10, 15 years, a lot of the electrical utility companies have been in like the ESG, pro ESG. So like they were talking about phasing out nuclear. They were talking about phasing out oil, natural gas, and coal. So, I mean, there was just like anti-conventional baseline electricity. So like nuclear got lumped in with the fossil fuel ones because a lot of the capital allocation and the policies were for wind, solar, biofuels, hydro, like those types of geothermal, those types of things. We're getting tons and tons of funds. We're still seeing that out of DC. So they weren't like, it wasn't just like the nuclear fuel buyers, like you said, it was also the policies too that were piling on too, that were negatively hurting the industry.
Yeah, it's true. Doomberg likes to say, I quoted him a couple of times today, but I think he's very prescient in his thoughts. He likes to say that the nuclear industry has basically failed in the propaganda war, and I largely think that's true. Maybe up until the last few years, everybody thinks about nuclear power. When they think about it, they think about Chernobyl. They think about Fukushima. They think about the Simpsons with the three-eyed fish swimming in the pond next to the reactor. So it's only recently started to kind of shift in terms of the eyes of the public. Now we actually have, for example, the majority of the Japanese who have been, they've experienced as a country the most recent accident from a civil nuclear power plant, yet the majority of the country is in favor of restarting nuclear and even building new nuclear power plants. And finally, over even just the last 12 to 18 months, nuclear is being embraced by the quote unquote ESG movement. So it's shifting slowly. There's been a number of things that have aided that. Of course, it's the climate panic and the demonizing of carbon has embraced nuclear is finally seeing it for what it is, which is a zero carbon energy source. Oliver Stone's film, I think, went a long way to kind of moving in that direction. But yeah, seeing an ESG movement embrace nuclear, I think, is a big shift on that front.
Yeah, the main point here is we'll see if they actually allocate the capital because they're talking about what tripling nuclear power plant capacity by 2050, but at least they're not blocking it. Because for the last decade, Justin, it just seemed like almost all the policies were trying to shut down or block nuclear power plants. And now it seems that finally the politicians are at least like getting out of the way and not trying to block it or sabotage it.
Yeah, I completely agree with you, Jason. That goal of tripling nuclear by 2050 is an incredible ask for multiple reasons. It's not just the financing side of it. I'm sure that the money could be allocated to accomplish it, but it's just a huge endeavor for the fuel cycle, for developing mines and training skilled labor for these mines, for establishing more conversion capacity, much more enrichment capacity, much more fuel fabrication capacity. It's a major undertaking. I'm hoping, I mean, just the nuclear advocate in me is hoping that it is accomplished. I mean, this investment will probably be long gone by the time that gets accomplished or doesn't, but hopefully it happens.
Well, most of the nuclear engineers, they're not young adults. Most of them are over 60 years old too in this space in like the US. Like I met some of them and I met one of them who's around my age, around 40, but he was telling me that like all his coworkers are over age 60.
Yeah, it's what do they call it? The Gray Tsunami, and I'm closely, I'm moving quickly towards being part of that. No, I don't remember the statistics, so I'm going to butcher it, but it's something like by 2030, 50% of the workforce across mining in the United States will be retired. It's something like that. It's a huge number, and of course, all of the young people want to be YouTubers and influencers. They're not interested in trades, but hopefully that'll shift. We're seeing the incentive shift. Somebody with just a high school diploma can get hired in the Bakken for $100,000 a year, whereas you can graduate with a gender studies degree and not get a job. I mean, it's moving that direction relatively quickly. So hopefully it gets better for the industry in that front.
So I really enjoyed our discussion today. I want to thank you so much, Justin, for the update on the uranium market. Definitely sounds really exciting. All these exciting news stories, a lot of new supply, the price is going up. What worries me though is all these hedge funds that are coming in now and they're all talking about like, oh, I did so well in this Cameco trade. It's like, dude, you bought those shares like a couple months ago and you just put it in your investor newsletter when Justin and I were talking about uranium as a contrarian value investment for over 12 months now.
Yeah, it's interesting, Jason. I mean, the story has been an evolving one over the years since I've been following the sector. I never would have dreamt in my wildest dreams that we'd be seeing some of the things we're seeing in terms of nuclear adoption or the severity of the supply shortage. It's truly astonishing, and I wouldn't have bet on any of these things 5 years ago, but here we are, and the story just keeps getting better. It's hard to say exactly what we're going to see in the coming years for this investment or for the industry, but I can tell you right now, we're not going to see an influx of supply. I don't think there's any surprises on the supply front. I wrote about to our membership last week that barring, like a nuclear accident, that of course would be a major hit to sentiment in the short term and the equities as well, unless it resulted in demand destruction. It's not really going to change the supply and demand outlook. It has to actually change the demand outlook, like Fukushima and Japan shutting down the reactors did. That's really what what spurred the bear market of the previous decade. But barring that, all of the risks here are right tail. I mean, we have a couple on the just coming probably in the next few weeks, potentially next few months, which is the Senate vote on the banning Russian uranium legislation. If that happens, yes, there's waivers technically, but how much can the industry rely on those waivers? Or will Putin actually, issue a decree saying, all right, you're going to ban us. Well, we're just not going to send it to you anymore. If that happens, it's going to cause a major disruption in the market, even just with the United States being cut off from Russian enrichment going forward. If that legislation passes, which I think it will, and if there's a Russian retaliation, I'm not betting on this, but that's a right tail risk. Another right tail risk is Kazataprom and their joint venture partners continuing to miss production guidance. Cameco potentially having production problems and signaling that to the market. There's multiple others, but all of the risks that I can see, Jason, they're all right tail, with an exception of like a nuclear accident. I just don't know where we're going to see an influx of supply that can actually change its dynamic in the near or even the midterm.
Yeah, because I'm trying to think of where the extra supply hit in the bear market in the past, and it was Kazataprom increasing production because they were the low-cost supplier and they had a lot of spare capacity and they overflooded the market. And then Japanese nuclear power plants that were dumping it back on post-Fukushima for, I don't know, 7 to 10 years, they dumped a lot of nuclear fuel rods back onto the market, a lot of extra supplies. I just don't see any of those things.
Yep. Yeah, you're absolutely right. And, one more element I can mention, I know this is kind of getting long in the tooth here, but I think it's really important to understand that there's actually for decades been at least a very small supply shortfall on an annual basis. So the supply shortfall from primary production is not necessarily a new thing. It hasn't been this large where we're talking about 30, 40 million pounds on an annual basis. But we've had abundant and reliable sources of secondary supply for decades. The Russians dumped an enormous amount of uranium into the global market in the 90s and into the early 2000s. We then had megatons to megawatts, which ran from 93 to 2013. That's 20 million pounds of down-blended warhead material into enriched uranium that was bled into the market. Then when we shifted from gaseous diffusion to gaseous centrifuge enrichment in the mid 2000s, we had a lot of enrichment underfeeding that was sold into the market as UF6, which basically was 25 to 30 million pounds per year. Most of that has dried up. The industry has been able to rely on abundant, cheap, and reliable secondary supply, and that's just not there. And that's a major element of this market right now, is that secondary supply is not helping to buffer this very large supply shortfall. And it's really, and this is not just me being the bullish investor newsletter writer saying this. This is industry guys with 50, 55 years of experience in the nuclear industry. We are in new territory. This is new. This is a totally anomalous situation right now. We don't have a historical precedent to look into the past to try to inform where this is going in the future. This is brand new territory, and it's with a backdrop of the nuclear industry growing by 3-4% compound annual growth rate. It's truly a unique situation. So obviously I'm bullish, obviously I'm long, but I don't know where this is going. There's nothing I can point to that says the price will go to this level and that's where it makes sense to stop. That's just completely off the table here.
And let me add to your points there. We also, for the first time in history, have almost 8 billion people on the planet, and almost everyone wants, all the adults at least, also kids want cheap, reliable electricity that we take for granted, and everyone wants to get on the internet and plug in their electronics devices. And the most stable form of electricity over the long term, cheapest one that I can see, is nuclear power.
Yeah, absolutely. And I continuously see over the past few months, especially the very large increase in electricity demand coming from computing power necessary for AI. So to the extent that we have a very rapid growth rate of AI, that's an enormous demand for electricity. It's going to have a much larger increased baseload electricity in order to power AI in the world, if that is the direction that we're going, for better or for worse.
Yeah, or electric vehicles, all these electronics, most
Right.
people on the internet all the time. I mean, all these things just use a ton of electricity that we just take for granted.
Right. Yep. Absolutely.
So thank you very much for your time, Justin. Honestly, I think you're the world's top uranium and nuclear power expert. I mean, I'm friends with Rick Rule, but you just rail off the facts even faster than Rick does and Cuppy does.
I'll take that as a very kind compliment. I appreciate it, Jason. Thanks for your time.